Ladies and gentlemen, welcome back. In this video, we're going to talk about buying and selling shares of stock using online brokerage websites, and some of the things that you should be alert to. If there's one underlying theme to all of this video, it's that you're in control of your investing destiny. If you're not, you should be. This is to say that you make your investment plan, you do most of your own research, and you make your own decisions about where to place your money. One of the developing trends in investing is the growing prevalence of internet-based brokerages. Now, in theory, this should be a great development for the individual investor who makes his or her own plans and decisions on investing. There is no need for brick-and-mortar offices. There is no need for a large support staff. There's really not even any need for human contact in the financial analysis. All you do is create your account, log in, and you can enter your order for the company and number of shares you wish to buy and sell. Click and place the order. The order goes from your computer to the brokerage, which is passed electronically to the stock exchange, and your order is executed. After that, the process is reversed to confirm that the order was executed in accordance with your wishes, and it is all done in mere seconds. There are many internet-based brokers, and as with full-service and discount brokers, they offer different levels of service and support at vastly different fees. We suggest you do your homework and find the one that's best for you and your style of investing that you plan to do. We do not promote one over the other. There are numerous reputable companies offering this service. Among the largest are E-Trade, Scottrade, and TD Ameritrade. You may have seen commercials on television for these services. As stated, the best online broker for you is the one most suited to the type of trading you plan to do. A good place to start is by looking at online reviews of internet-based brokers. Some reviews break down their data to show which brokers are best for various types of traders. By familiarizing yourself with these reviews, you will begin to better understand your options and factors you should consider when you make your decision. First, think about how much trading you'll do. If your overall plan is to invest in a retirement account or an education savings plan, you probably will trade fairly infrequently. If this is the case, you may simply want a reliable broker that offers a good selection of investment products along with some tools for research and analysis. If, on the other hand, you plan to trade frequently, look to brokers that offer low commissions and fees, and perhaps tools for frequent trading. They sometimes call these trading platforms. Some sites appeal to very high-volume traders or day traders, with services such as direct access trading and mobile access. The point is, consider how you plan to invest and what services and tools will best serve your needs. After you're doing your research on some of the internet-based brokers and their services, go to that online broker's website, look around, then read everything on the broker's website about commissions and fees. Before opening an account or before trading, understand what the broker charges in way of commission and trading fees. Don't get blindsided after the fact. Understand ahead of time if the broker charges differently based on the size of the order or the trading frequency. Also, investigate any additional fees, such as account minimums, inactive fees, or even a fee to close or transfer your account if you should decide to move your account to another broker. Be certain to understand their rules on account minimums. Some, but not all, require a minimum investment amount to open the account, or provide low commissions, or even access some of their research and trading tools. Some fee structures are complicated because they require different levels of minimum investment to access and utilize their more sophisticated trading tools and platforms. You may not be seeking to use some of their sophisticated trading tools, and so does it not matter to you. Nonetheless, understand the rules, be aware, always know in advance what to expect in terms of minimums, fees, and other requirements. Sometimes this is the footnotes or the fine print at the bottom of the screen. Be savvy, look for it and read it. The lesson here is to know what you're getting into before you electronically sign anything and send in your hard-earned money to fund your account. While you're on the website, look for any free trading tools they offer. Some sites offer real-time stock quotes, free research on stocks, and general investing tips and education. These can be helpful and enlightening. Most sites will even give you a peek at what they have to offer, but remember, these websites are selling tools. That is to say, tools for selling you on their services. Look at everything. You may not need some of their snazzy services if using it is too involved or complicated for your purposes. Here again, it is a matter of your personal choice. But I would say choose trading tools that are commensurate with your level of investing and computer skills. Consider placing all of your investments in one place. It makes it easier to monitor and execute your trades if you only need to log into one brokerage site. Most enable you to link multiple accounts, so one login provides you access to multiple accounts. Having all of your accounts and investments at one brokerage also makes it simpler to access monthly statements and assemble what you need at tax time. Again, choosing a broker that provides a broad array of investment products and services will give you the breadth of service to meet your needs across your various accounts. You should also consider the interest you will earn. Compare the interest rate you'll earn on the cash balance in your account at the different brokerages you are considering. It will probably be similar, but you may be pleasantly surprised and pleased that you took the time to investigate. Also, review the online broker's policies on security. Does it guarantee that your personal information is protected and that your account is insured? Do not hesitate to seek out articles online about the broker to see if there are any recent reports that might send up any red flags. Now, let's think about successful online trading. The same principles apply to online as offline investing. You need to have your plan in mind. You need to do your research on the overall market, industry segments, and the individual company that you're investing. Again, remember the importance of patience, especially if you are a long-term investor, which we recommend you do become. With online trading, you will see that trading is easy and fast and relatively inexpensive. So you must really exercise discipline and patience. Always learn as much as possible. The investor with more and more accurate information going into making a trading decision will always do better than the investor with less and/or less accurate information. The first step to being successful at online investing or trading is to spend time researching the market. You are your own best investment. Invest in your education about investing. This can be time, money, or both. Successful investors are constantly learning and growing in their understanding of markets, companies, and the tools and techniques of successful investing. This knowledge will be especially valuable when you need to react to changing situations and fly by the seat of your pants. Some say the golden rule in investing is that there is no golden rule. Their point being is that there is no ideal system that always wins. Every successful share investor or trader, online or otherwise, has their plan and they stick to it to determine what and when to buy and what and when to sell. You have to work on developing your plan and sticking to it, even though those inevitable failures will come along. A part of your plan, and you could just as easily call it a system, are things such as setting limits of when you cut your losses and how much risk or loss you're willing to accept before selling out, before dumping your shares. In other words, have predetermined conditions or limits for when you will sell an investment even before you buy it. This is a rule that applies equally to offline, real-world trading as it does to online trading. But it is especially important when trading online because too many people tend to overlook them, thinking the computer will do the work for them. You can enter provisional orders that will execute a buy or sell order when the selected conditions exist, but it is your money and your responsibility to stay informed of changes and make your own decisions. If you're going to invest online, that is, with the intention to win, you must develop patience to wait for the right deal at the right price. Do not make the mistake of taking on a risky trade just for the action, or just because it is easily executed with a couple of keystrokes, or, for worst reason of all, because you feel that you need to remain active in the market at all times. Patience is an important part of discipline. Your research may teach you how to read a balance sheet and other techniques and mechanics of investing, but patience and discipline comes from within, you only after you make a conscious decision to exercise them. If you are constantly jumping in and out of the market, buying and selling shares every 5 minutes, you're going to wear yourself to a nervous frazzle, and you'll be incurring some sizable commissions and fees that will eat into your investment returns. With online trading, it is far too easy to fall into that trap. Do not. Online trading can reveal to you both the details of trading, but also the larger picture of the market and its ebbs and flows. You need to be aware of that larger perspective on the market and your investments as a whole. It is too easy to get lost in the details and lose all that important big picture view. Guard against that. Remember your long-term goals and exercise the discipline and patience to see you through to the long-term success. When you do trade, you'll have the option of different kinds of orders. The most commonly used are market orders, which they execute a buy and sell order at existing market price. However, there are a variety of order types that you can use, such as limit orders, conditional orders, stop market orders, stop limit orders, as well as triggers that you can set to alert to certain market conditions or even to execute an order under selected market conditions. A little research can clarify any confusion that you have about these alternatives. Now let's turn to some cautionary advice in any investing, but especially in online investing. You will see blogs, you will see bulletin board postings, and online newsletters. Do not make investment decisions based on these sources. These sorts of unofficial information sources are where exaggerated claims about developments, pending patents, big contracts, etc. are sometimes made. You do not really know what the source of this news is. It may be hearsay, or may even be the work of unscrupulous promoters. Do your own independent research to verify those claims using unbiased sources such as official news releases from the company itself. Do your own homework. Frauds and scams are unfortunately rampant. Be especially cautious about small company news. Their stock can be a little volatile and susceptible to fraudulent manipulation. Before doing any internet-based trading, be sure which stock exchange that actual stock trades on. National exchanges have listed requirements that many small companies cannot meet. The companies trade in what is called the over-the-counter or OTC market. We've discussed this. Stocks that trade in the OTC market are among the most volatile and thus risky and susceptible to fraud and manipulation. We suggest you stay away from so-called penny stocks. Some people actively trade these, but they are not for the disciplined long-term trader that we hope to be. So, to recap this section, be cautious and skeptical of small company investing and non-official news sources. Now, if you do find yourself on a telephone call with someone touting an investment opportunity, especially one of those supposed once-in-a-lifetime opportunities, stop. Take a breath. Take a step back. Take an objective look at the situation. We urge you to think about why this person is letting you in on such a wonderful opportunity. Why? What do they have to gain, and at whose expense? We advise stick to legitimate sources and known companies. There are plenty of opportunities for sound investing and long-term success in traditional investing. Don't get suckered in by the appeal of quick riches on inside information and tips. Now, this completes the video about online investing and how to research an online broker that is well suited for your objectives and investing style, along with several reminders on taking care in your investing online and offline. And as always, we emphasize the importance of developing a thoughtful plan and executing that plan with rigorous research and prudent decision making. You can have the capability of doing this by watching these videos, by listening diligently, and by taking those notes. We wish you all the best of luck in the world.